Welcome, everyone. My name is Ruben Izgelov. I am the managing partner at WeLend. Welcome to our webinar, and I look forward to walking you through the benefits of investing into the WeLend's fund and why it makes sense to do so. WeLend was founded coincidentally in 2018. The purpose of WeLend is to originate, purchase, fund, and acquire, and from time to time, of course, sell private hard money loans secured only by first position liens on real property and personally guaranteed by every single borrower, primarily on the East Coast, but we also go nationwide. We like to focus on the East Coast because it is our backyard. To date, we have funded about $525 million in short term business purpose loans. That's across 1,250 loans. That brings us to an average loan size of about 400 to 450,000. Loans today, and we're very proud of that, are primarily made to experienced, sophisticated real estate investors who are in the business of rehabilitating discounted investment properties that they're able to find off market. They're able to do so and buy them at a steeper discount, putting us in a much safer part of the capital stack. The fund today is run by experienced real estate investors and now lenders who provide a keen insight into what makes a good loan from a bad loan or what makes a good investment from a bad investment. We are also personally invested into the fund, which definitely aligns our interests with yours. The fund intends to select and sell specific loans and also hold some loans on the balance sheet. When we do sell loans, it enables us to mitigate our risk, but also compound our money, enabling us to return a much higher return to our investors. When we hold loans on our balance sheet, by levering up those loans on our existing warehouse facilities, that too enables us to hit a much higher return than what the coupon is to the borrower. A little bit about us. Like I said, I'm Ruben Izgelov, managing partner here at WeLend, and also one of the co-founders. Moses is our head of underwriting, also one of the co-founders, and Solomon is head of originations, also one of the co-founders. Moses and Solomon are brothers, and we three are cousins. Our parents are siblings. So we are united as united can get. Can't get rid of each other, even if we wanted to. We have done purchasing, flipping, developing for many, many years prior to starting WeLend. In fact, the way in which we founded WeLend was coincidentally, like I mentioned earlier in the slides. We wanted to find a cheaper source of capital and liquidity for the deals that we were doing. So a little after law school, I wanted to just shake law school off and find that cheaper cost of capital. So Moses and I, we jumped on an airplane and we flew out to the West Coast for, at that time, the Pitbull Conference. That time run by Leonard Rosen, and today it's called the National Private Lenders Association, which I am on the advisory council of, run by John Horner. We went into this conference as private investors and developers. We walked out as private lenders. We've never looked back since. And like I mentioned, since then, we funded about $600 million in loans and across 1,250 loans, like I said, bringing our average loan size to about $400,000. So we have the experience that it takes to keep running this ship. Now, the investor security. Why would you want to invest with us? Well, one, we are aligned with you in the sense that we are personally invested into the fund. We have a little over $2 million to date invested into the fund, and we continue to try and reinvest our distributions versus cashing them. In addition to that, we don't make money until you do. So we are aligned in many different ways. Additionally, we're able to sell our loans and also produce a velocity of capital. Every time we sell our loan, we capture usually anywhere between 75 to about 150 basis points on every sale. Assuming we do that once a year, 12 once a month rather, 12 times a year, that brings us to about a 20% return. In addition to that, by doing that, we're also able to mitigate our risk in the event that there's any type of market shifts. We're no longer holding those loans on balance sheet. In addition to that, being a lender, it's natural that you're in a much safer part of the capital stack. You're backed by real estate and you're the first position lender on the property. So we're always collateralized and personally guaranteed by every single borrower. By also investing into a fund with a pool of loans, you're able to achieve diversification. So essentially, your loans, your money is diversified amongst a number of different loans through a number of different resilient asset classes, diversified a number through a number of different borrowers. So the risk is spread across a portfolio of loans versus just one single loan. In addition to the other four points of investor security, underwriting for us is crucial. It's critical. Moses is the head of it. He crosses every T, he dots every I. He's very analytical. He's great at what he does. But every single loan has to meet a stringent underwriting guidelines and also those of our institutional loan buyers and our warehouse facility. So every single loan we make, although we plan on holding it in our warehouse facility and balance sheeting it, we still make the loans with the intent of selling that in the event that we need to. In addition to that, the fund is fully transparent. And the reason why is because one, we have a third party loan servicer and also a third party fund administrator. We don't do it in house. We want to make sure that the transparency is accessible to you at any time. Most importantly, and this is the one that every single bar investor likes rather, that is the fact that the distribution frequency is instant. Almost after 30 days to 45 days of your investment, you begin receiving monthly distributions. And that averages anywhere between 1 to about 1.2 to 1.3% on a monthly basis from the day that you invest. So our investors love it because they receive a passive cash flow on a monthly basis. So it definitely attracts them to invest. In addition to that, our investment is risk adjusted in the sense that while we're generating above market return, the fund reduces the exposure to market volatility by making the short term nature of our loans. Every single loan today, it's at about 12 months, but they're repaid usually within 8 to 11 months. Fundamentally, debt investments are essentially much safer than equity investments. And the reason why, naturally, is because before any equity investor in any deal takes out a penny of their money, you could ask me, the lender always gets repaid first. Many years ago, when I purchased a property in the Bronx with Moses and Solomon and my brother, we purchased the property. We put all the work into the property, but at the end of the day, we didn't sell it at the price that we expected to. So we ended up losing money on that deal. But the only person that made money on that deal was our private lender. And at this time, that's when the light bulb went on as to why I should be a private lender versus a private investor. So those are the investor securities for you guys. Now, what are we offering? Today, we're hitting about 15.5% returns with monthly cash flows. That is essentially a waterfall structure, meaning that before I take out any money, you have to be hitting a return of about 7 to 8% preferred return on your investment. Then after that, we have a split of about 70-30, 70 going to you, 30% going to us, bringing your investment return on an annualized basis to about 15%. The average investment today is right around 400,000, but the minimum investment is 250,000. And this is only available to accredited investors. Non-accredited investors are unable to invest into our fund. That is an exemption through the SEC. It's a 506C Reg D fund. Now, a lot of questions revolve around this specific slide. Ruben, you're making returns at, you're making loans at around a 12% coupon to the borrower, but yet we're hitting a return of 15%. How is that possible? Well, guys, that is the beauty of velocity of capital, also the beauty of leveraging the loans. So let's just say, hypothetically speaking, we make one loan once a month, 12 times a year. Let's just say every time we sell that loan, we capture, and we're using hypotheticals here, we capture a 2% spread on every single loan whenever we sell it to our institutional loan buyers. Assuming we sell that once a month, 12 times a year, the math is easy, 2% spread over a 12-month period brings us to about a 24% return. That is how we're able to hit the attractive returns to our investors while still mitigating all the risk to our future loan buyers. Now, some key facts about how we've been doing, what we've been doing. So, to date, we've managed to fund and originate $525 million in loans. It's not easy to do, but it was done across 1,250 loans with an average leverage at purchase of about 77%. So, what does that mean? That means that the borrowers are coming in at an average of about 23% of skin in the game from the outset. In addition to that, they have closing costs and they have to start the construction. So, yes, we do fund the borrower's construction, but all the time they have to start the work before we actually fund them. So, it's more of like a reimbursement than anything else. So, essentially, while on the surface it looks like they're only bringing in about 23% of skin in the game at the purchase, realistically, after closing costs and the start of the construction, they're at about 35% of skin in the game in every single deal. We like that because then that just aligns us with the borrower. Also, today, 61% of our borrowers are actually returning borrowers. We love that. We are relationship based. It's helpful for us and it's helpful for the borrowers. So, being that we are actually trying to focus on existing borrowers, it enables us to continue with the high performance loans that we've been receiving. Now, this is huge. This is a headwind right here. Zero principal loss. To date, since 6 years of inception, $525 million of loans across 1,200 loans. We have never lost a dime of principal. We're very proud of that. 9.9% is our average interest rate today. Although, if you look at about, say, the last 6 months, it's a little higher than that at around 11.25% on an average across all our loans. In addition to that, we currently have about 220 to 250 active loans that we are co-servicing. Like I said, we have a third-party servicer. They are the master servicer, and we co-service every single loan. We like to keep our finger on the pulse. The average loan size is right around $402,000. Meanwhile, the average leverage against the after repair value is right around 59%. That is huge, guys, because what that essentially means is that every time we make a loan, once the property is completed, there is about 41% of equity in the deal that is built in for our own safety. So, in the event that we had to take back a property, which we wish we never have to, but in the event that we do, we will have about 41% of equity for us to be able to recuperate our principal plus our unpaid interest. So that is a very, very important metric because that also forces the borrowers to complete the projects and pay us off much quicker. Now, the average FICO today is right around 695 for every borrower. Yes, we check their credit. We are hard money lenders, private lenders, but we're still somewhat institutional because we like to do a full background search on the borrower and check their credit. 74% of our borrowers are experienced, sophisticated borrowers, which means that they're able to buy properties at a much steeper discount than a non-experienced or sophisticated borrower does, which puts us in a much safer part of the capital stack. Like I mentioned earlier, the average loan term of our loans is right around, well, not the average, but the loan term of our loans is right around 12 months, but the average is anywhere between 8 to 13 months. Anytime a loan goes beyond that 12-month threshold, we're able to capitalize on that by charging extension fees. The average net worth of a borrower is right around 2.5 million. That's huge because the average loan size is about 402,000, which means that the borrower is putting a personal guarantee on the loan and being able to cross collateralize on all their existing loans has a lot more to lose than they have to gain. The average age of a borrower is right around 44%, coupled with a 695 FICO score, 74% of our borrowers being super experienced with an average net worth of 2.5 million. That puts us in a position where we know the borrowers have the wherewithal not only to finish the project, but to exit from it through a refinance or through a sale. So, typical loan characteristics. Now, bear in mind, being a hard money lender, we never make consumer loans. These are only business purpose loans. which means that we have no consumer facing rules or regulations that we have to follow. We do obviously have to work ethically at all times, but that means that in the event of a default, we're able to capture and foreclose on the property much quicker than if it was a consumer facing property. In addition to that, the property types usually is right around 1 to 4 units, 4+ units, which is multifamily or greater, and mixed use properties. Now, that's very important because we like to focus on residential properties. Now, yes, multifamily, they're usually commercial in nature, but there's always someone living in those properties versus a retail project or an office use project. And we see everything that's happening with the offices. You see that most of the buildings here behind me are probably vacant. But nevertheless, residential, it's been a much resilient asset class where we've seen amazing, amazing performance on. Now, most of our loans are fix and flip in nature. These are short term duration loans. Borrowers are buying properties that are physically, financially distressed, reposition them, and ultimately having an exit. We also do provide DSCR loans, it's a rental product, multifamily financing, and new construction. However, I would like to make sure to note that most of our loans today are short term duration, fix and flip bridge financing. Now, we market ourselves as nationwide private lenders, but I'll be honest with you, our focus really is in our backyard, which is the East Coast. I would say the three leading states for us today is New York, of course, that's where we're located, New Jersey, and Connecticut. So, although we market ourselves as nationwide, we're really tri-state focused in the Eastern corridor. Um, Now, the borrowers, they are primarily experienced individuals who are buying these properties at a huge discount to purchase, fix, and flip. Most of our borrowers are in the fix and flip space. Some hold them in their portfolio and continue growing that portfolio. The average leverage at purchase is anywhere between 77 to about 82%. However, we always want to make sure that the borrowers have at least 15 to 35% of skin in the game on every single deal. We want our interests to be aligned. That is crucial for us, just as it is crucial for you and us to be aligned. The average rate today is right around 11 to 13%. That fluctuates from time to time. If you look at our portfolio from the onset, it's about 9.9%. But if you look at our portfolio of, say, the past 6 months, it's about 11 and a quarter to about 12% return rate to the borrower. Now, the average length of the term, and I might be repeating myself, forgive me, but these are very important points to make, is 12 months. But 8 to 13 months is the average term. That's mostly when the borrowers are repaying because they're buying the properties, they're fixing them within sometimes a couple of weeks, sometimes a couple of months, and it just takes them a couple of months to actually sell the property or refinance. So most of our loans are repaid within 8 months, but some do go beyond that 13-month timeline. And in the event that it does go beyond that timeline, we have the ability to charge extension fees. Now, the extensions are not built into our loan documents. It's upon our discretion to make the extension or not. And we usually look at circumstances related to the asset, right? We look at circumstances related to the borrower to see whether an extension is warranted or not. If it's been a good borrower, they've been paying us on time, the project is moving along, there are reasons why there was a delay, valid reasons, we'll give them an extension. We want to help them. But in the event that the borrower has been giving us a hard time not paying or anything to that effect, well, we won't grant an extension. Now, construction financing. Now, like I said, most of our loans today, they're fix and flips. Borrowers are buying, fixing, flipping properties. So there's always a construction component attached to them. I would say a good portion of our loans today are we're financing the construction for them. That enables us to do a number of things. Well, one, manage the asset, see exactly where the property is positioned, how they're moving along, if they're moving along. So it allows us to manage the asset because we get live time feeds of where the property is standing because we do a construction inspection on every time the borrower does a construction draw. In addition to that, while we are able to manage the asset, we're also able to make sure the borrower is aligned with us. Again, alignment of interest is very important. So what that means is the borrowers are always adding value to the asset before we give them any more money. That is very important to us because now we know that the value of the property is appreciating and the borrowers have more skin in the game Again, alignment of interest is very important. So, what precautions are we taking to implementing to reduce any market volatility and exposure? Huge for us. We're personally invested. My aunt is invested. My uncle is invested. So we want to make sure that we are personally making sure that we do everything we can to avoid any market volatility or exposure. So one of the things that we're doing is we're tightening our lending criteria and underwriting. We're increasing our credit standards. Like I said, today the average leverage is about 77 to about 80% on acquisition. The borrowers have a lot of skin in the game going into the property. In addition to that, the average FICO is around 700, which means that they're institutional grade with a $2.5 million net worth and their experience. So tightening our credit boxes is crucial. We also stress test every single borrower's exit strategy. So we do an appraisal on every single property. We have certified appraisers, insured appraisers to do the appraisals, but we want to make sure that those appraisals have valid comparables, right? They have valid exit strategies. So we look through every single appraisal. We look through the comps, whether they're rental comps or sale comps. We want to make sure that those comparables are in fact comparables to the subject property that we're financing. It's very important for us. So we stress test every borrower, every exit strategy to make sure that in the event that they can't sell the property, let's just say they can't for whatever reason or they choose not to, they still have the ability to pay and continue paying our mortgage in the event that they don't sell the property. Now, we also want to focus on a lighter rehab properties. So, the average today is around $100,000 construction on every property. So we like to focus on the lighter rehab versus the 400 or 500 or $2 million constructions on the property. So again, lighter rehabs for us is a focus, and we like to keep the average loan size to the median cost of housing. That's why our average loan size today is right around $400,000. Now, we've also narrowed our lending landscape from national to regional. Like I said, the East Coast, the tri-state area is our focus because that's our backyard. In the event that we have to take over a property, we're able to do so and navigate fairly quickly. Now, typical loan funding process, and this is where kind of Moses and his team comes in, and they shine the best way they can. So first and foremost, the borrower comes in with a loan application. They come in with a loan request. They provide us an application, and it's an extensive document with supporting documents as to what they plan to do, where the property is located, what their experience is like, what their FICO score is, and so on. It then moves over through our automated systems, through our technology that we've built personally today. It goes into the processing department. That is when all the documents begin collecting, right? That's when we start collecting all the documents. Now, that includes personal financial statements from the borrower, schedule of real estate owned. Now, when we do a schedule of real estate owned, we want to know, you can't just tell us that you're experienced. We want to verify that you're experienced. So we go through every single property that they present to us to make sure that the borrower was in fact tied to the property. We also look at their scope of work. What do they plan to do with the property? Right? Because if they're buying a property and telling us, hey, it's going to be worth $1 million after we're done with it, well, we want to know exactly what you're doing to bring and effectively bring that value to $1 million. Our appraisers look at it and they tell us, hey, look, with this scope of work, yeah, they'll bring the value to $1 million, or maybe not. And that's very important for us. We also pull a credit. We do a background search. We do an OFAC search, and we order an appraisal through a certified appraiser. Now, after that, it goes into the underwriting department. Another level of underwriting and another level of review. That's where all the background searches are reviewed. The credit reports are reviewed. Look, a credit report might have a 700 FICO, but they have no trade lines. What does that mean? That means nothing, right? That means that the guy doesn't really have credit. So we want to make sure that the trade lines are essentially valid enough for them to be able to take out a loan in the event that they can't sell or choose not to sell the property. So there's a huge process that goes on after all the documents are processed and collected. After that, once we kind of softly approve the loan internally, it goes over to a review to our loan buyers or our credit facility. There's another layer of review. So there's many reviews that come into place. We want to make sure that it's a loan that can be put on our balance sheet and our warehouse facility, or it's a loan that we can sell in the event that we choose to sell it when we choose to sell it. Then it goes into a legal review. Now, I am an attorney myself, but I am personally not reviewing these documents. We go to the best of the best in the private lending industry to make sure that they review every single loan that we make. They're looking at the title, they're looking at the insurances, they're looking at the legal documents that the borrower provides. They're making sure that we are compliant in every fashion and making sure that we are secure. They also make sure that the loans are recorded in a first position lien on the property and personally guaranteed by the borrower. And then we schedule a closing. That's kind of like the fun day, right? For us, for the borrower, for all of us here. That's when the closing is scheduled. Once all these reviews, all the T's are crossed, every I is dotted. And once the loan closes, we either choose to sell the loan or we hold it on our warehouse facility and we replenish our money by doing so. So why do borrowers come to us versus a traditional lender like Bank of America, Chase Bank, or what have you? Well, first things first, speed. We fund loans as quick as 3 business days. To be honest with you, we fund the loans as quick as 24 hours, sometimes even 18 hours. So we're very, very proud of that. We're able to move a lot quicker. We're able to review documents much quicker. We don't need a lot of the red tape that many of these banks do. So we're able to move a lot quicker, and that's why most of the borrowers work with us. In addition to that, the assets condition, right? So that's why borrowers come to us. It's very possible that the property is a foreclosure auction. They only have 30 days to close, and there's a roof missing. Literally, there could be a roof missing because there was a fire. There could be some serious problems with the house in terms of the construction that is necessary. It is not habitable. It's not mortgageable. So that's where we come in because we finance those properties because we know that the borrower is buying those properties with the intent of rehabilitating them and moving on to the next asset. In addition to that, very low red tape, right? So we move a lot quicker. We don't need tax returns. We don't need bank statements. We don't need to see their W-2s in terms of the borrowers. We move much quicker because we just have very few documents that we need. In addition to that, we're very competitive in terms of our financing terms, in terms of our rate, but also we provide them with all the guidance that they need. Remember, my partners and I, we were fix and flippers ourselves for many years. So we know what it's like to finish a project and do so in a timely fashion and do so under budget. Why invest with us? Kind of touched up on this a bit earlier, but I think it's very important to stress again why you should be investing with us. One, we are aligned. We are invested alongside you. We don't make money until you make money. Two, we sell our loans. We're able to enhance our yields and mitigate our risks by doing so. Thirdly, we are diversified. You're not investing into one single loan. You're investing into a pool of different loans amongst other asset classes, borrowers, and geos. Principal protection, we are real estate backed. We are always first lien positions, and we are in the most safest part of the capital stack. And I must mention, we have zero principal loss. Underwriting and deal flow, and forgive me for talking so fast. My team wants me to keep this under 30 minutes, and we're at about 28 minutes. So, underwriting and deal flow, very important to us. We want to make sure that we follow very stringent guidelines and transparency. There are third-party administrators to our fund. There's third-party administrators to our servicing of every single loan. And also, we're experienced. We've done this plenty of times. We've funded 1,250 loans across $525 million. We've personally invested into the fund, and we've done over 100 transactions similar to the ones we're funding today. And look at that. We're at 29 minutes. So thank you so much for taking the time. Once again, I am Ruben Izgelov, managing partner here at WeLend, and I look forward to speaking to you very soon.